This crazy market seems to be unraveling before our eyes. Sellers used to be able to slap any price on any house and bam, sold in one day, 10, 15, 20% or more over asking. And it's not like this was a long time ago. This was just 3 to 6 months ago. Sellers are now basically willing to look at any offer with any type of financing and hold on to your hats, willing to lower their expectations. It's called price improvement in marketing lingo. According to an online real estate company, in the 4 weeks leading up to June 19th, there were 6.1% of homes for sale that dropped their asking price. Unheard of before. One of the biggest contributors to this is skyrocketing mortgage rates. There's no other way to describe it. We started the year in the low threes, and just last week, that rate was close to 6%. Clearly, this has had a profound effect on buyers. You know, if you overprice your home in today's market, you're going to hear crickets. No buyers would dare step into your house. The last 3 years have been amazing times for sellers. Those days are gone. Buyers' buying power is not the same. I can literally see it in some of my buyers' eyes. Their dreams of home ownership is slipping away. Day by day, it just keeps getting more expensive to buy. On the flip side of this, some homeowners that are thinking of selling still have this preconceived notion that everything is still going in their favor. Translation: high prices, ultra fast sale. And not because buyers don't want to buy a house anymore. We have plenty of would-be home buyers. It's the continuing sky-high prices and ever-increasing mortgage rates that's stopping these buyers. There was a recent report from the Mortgage Bankers Association that said rising mortgage rates have increased the monthly mortgage payment on a medium-priced home an estimated 60% more than last year. The median monthly mortgage payment has jumped by $513 from the start of the year through May. These mortgage rate increases are affecting a lot of first-time buyers and also a lot of buyers that are buying in the outskirts of metro areas. For instance, here in the Bay Area, I'm talking about places like Stockton and Modesto. You know, places that are like an hour and a half to 2 hours away from the city center. These are areas that a lot of blue-collar workers that move to because they are getting priced out near the city centers. These group of home buyers have a more modest income, and the challenge that they face are not only rising mortgage rates and continued rising home prices, but the effects of inflation as well. With the high cost of rent near where jobs are located, they look to these places to buy a piece of the American dream. But right now, there is no refuge for them, if you will, because that increase of $500, $600, $800, or $1,000 in mortgage payments, coupled with pretty much all household expenses going up, is kicking them out of home ownership. And then you have the threat of layoffs on the horizon. It just presents more instability in the market or reluctancy in home buyers. Now, make no mistake about it, there is still demand out there. And to be honest, still strong demand, but not the same as 3 to 6 months ago. Let me give you a basketball analogy on how this thing is playing out. In the NBA, seldom do you see a player of KD's caliber become available in normal years. This month, KD became available because he doesn't want to play for the Nets. That there is our supply. You have one highly in-demand superstar that just became available. The thing is, there are 29 other teams in the NBA that would really be interested in KD. That there is our demand. But the reality is, because the high price you need to pay to acquire KD is beyond steep, only a handful of teams can pay the price, if you will. And then you have Rudy Gobert. Rudy Gobert from Utah just got traded to Minnesota, and Minnesota practically gave Utah everything that they have to acquire Gobert. Think of this in our housing terms, like all cash offers, no contingencies, buyers pay for your moving expenses, and lets you stay 90 days for free in the property. Perks like that just to get you to accept their offer. And FYI, Gobert is nowhere near close to KD's talent. Now, in order for teams to get KD, they most likely would need to pay more than what Minnesota paid for Gobert. And again, it's a very steep price to pay, and no one wants to step up to the plate because of all the uncertainties that surrounds KD. And the Nets are not willing to let go of KD for anything less because they have something that teams want. Okay, so hopefully you understand my basketball analogy. Going back to houses. While demand might not be that high anymore, supply is still very limited. Instead of the 10 to 15 offers or maybe Now, maybe 2 to 3 offers, or God forbid, only one offer at asking price. Demand is still strong, but not nearly as much as 3 or 6 months ago when the market was at a feverish pace. This is according to the president of WSFS Mortgage, Jeffrey Rubin. He continues on to say, we would see multiple offers, sometimes 10, 12, or 15 people bidding on the same house. We're not seeing those stories today. As the cost of mortgage continue to increase, buyers across the country are starting to have less and less confidence in buying a house. One statistic that I saw said that approximately 57.8% of home offers face competition on a seasonally adjusted basis in May, the lowest level recorded since February of 2021. That's down from a revised 60.9% 1 month prior. It's also a decline from 67.8 in April and marks the 4th consecutive drop in the bidding war activity. It's now clear that the last few months when we saw the frenzied rush of home buyers trying to find a home and thereby pushing prices up again was because home buyers were trying to lock in low mortgage rates. And because of that unusual activity, we are now faced with a softening demand. The pending sales number actually rebounded or went back slightly in May because there was a brief pullback in rates. This broke the 6-month decline that we've been seeing. So even though we saw this bounce back, the reality is that home buyers are still in a tough position in terms of affordability. And if we look at the numbers year to year, pending home sales were still down 13.6% from 1 year ago. That's a big decline. All these things, rising mortgage rates, inflation, rising home prices, and talks of a recession has effectively cooled the housing market. Pretty much all the data that I have seen has said that touring or showing activity is down since the beginning of the year compared to an increase when we look at last year. Another sign that there are less buyers is mortgage applications. It's down 10% from 1 year ago. And according to Google, fewer people search for homes for sale during the week ending June 18. That's down 14% from a year ago. I think all these things are kind of disproportionately affecting first-time home buyers. Unlike a current homeowner who needs to sell and buy again, most first-time home buyers don't have access to these types of equity gains that homeowners have experienced in the last 2 years. Again, don't get me wrong, these are definitely challenges, but demand is still there from this segment of the market. Still, data is showing that 34% of homes that went under contract accepted an offer within 1 week of hitting the market. That's down from 36% from 1 year ago. Meanwhile, 48% of homes went under contract within the first 2 weeks on the market, slightly down from 50% a year ago. So right there, clearly, we can see that even though demand is down, it's not severe. On average, homes are only staying on the market for 17 days. While again, that number is up from only 15 days, that's still insanely fast. These numbers used to only apply or can be seen in a hot market like the Bay Area. But these numbers are actually nationwide. For context, 30 to 60 days used to be the norm. And so far, over half of homes that are selling are still selling above list price. And this is why buyers are frustrated. They hear things like it's slowing down, inventory is up, and yet when they go out there shopping, it's still very competitive, and many of them still can't find a house, or worse, can't compete with existing homeowners who come in with a ton of cash from the equity of their homes. So what will crash this housing market? I mean, not slow down, but an actual crash. For me, it's going to be mortgage rates. If the Feds continue their increase of the Fed's fund rates, this will push us to the brink. Quick side note, the Feds don't actually set mortgage rates. They set what we call the Fed funds rate, which affects borrowing and bond yields. This has a direct correlation to the mortgage rates. So if the Feds hike rates, mortgage rates gets affected. Okay, let's go back to why I think the Feds could crash this housing market. I believe with rates around 6%, it's already elevating borrowing costs, which has started to stifle price-weary home buyers. If mortgage rates go past 6.5% and higher, this will definitely put a stop to demand. If demand drops big time, guess what home sellers needing to sell will start doing? Lower their prices. And this can and will snowball in a blink of an eye. According to the Mortgage Bankers Association, this rapid surge in rates has cut through home buyer confidence and is causing activity for purchase applications to dwindle in recent weeks. Forecasters are saying that there is no end in sight. They still expect that the Feds will continue to increase rates. If this does happen, it will be painful. While we still have historic inventory shortage in housing, a severe rate hike won't solve the problem. It will only price out everyone. It might take time for us to go back into a more balanced market. And this is one of my main issue with the Feds. Even though they are not setting mortgage rates, they know that their actions are causing all this. They are trying to slow down this rapid increasing in home prices by making it more expensive for everyone to buy a house. I'm not an econ major, but I know that manipulating prices or whatever type of manipulation you do in the markets never ends well. It's clearly not the way to go about solving the inventory problem. And here's another thing that I take issue with the Feds, specifically Fed Chairman Powell. I saw this on MoneyWise. Let me read it to you verbatim. Fed Chairman Jerome Powell on June 14th told millennials and other first-time home buyers that right now is not the time to invest in housing. He said in his speech that prices may continue to climb for a while as it continues to be a tight market. If you are a home buyer or a young person looking to buy a home, you need a bit of a reset, Powell said. We need to get back to a place where supply and demand are back together and where inflation is down and mortgage rates are low again. I do not understand this thinking at all. First of all, he equates home buying to investing. While it's true that buying a home is an investment, it is first and foremost a necessity, a roof over our head. And this is why a lot of home buyers get caught up with what home prices are doing or what interest rates are doing. Look, I get it. Those are all part of the buying process. But we lose sight of the bigger picture when we start treating our homes as an investment instead of a basic need. Then he said, we need a reset. What the heck does that mean? How do we get back to supply and demand back together by hiking interest rates? It seems to me that he is telling millennials and would-be first-time home buyers to just wait it out. Wait for what exactly? People to die so that we can start having supply of homes? I mean, that's nuts. It's like telling people, wait for gas prices to go down before you gas up and make that trip. It's not like rents are going down or home prices are forecasted to go down. And even if home prices do go down, you still need a place to live. We get caught up in treating our homes as an investment that every fluctuation in price rattles us. Look, when you buy a car, the car depreciates every time you drive it. And yet, we don't go all crazy that this is happening. Real estate, on the other hand, is an appreciating asset. But the decisions first-time home buyers make around purchasing a home, most of the time, is not rooted in facts. I guarantee if you look at your actual numbers, prices, mortgage rates, long-term returns, rents, when you factor all those in, you would come to a better conclusion in regards to buying a house. So I do believe that if the Feds continue to raise borrowing rates, which in turn affects mortgage rates, this could be the catalyst that completely puts a halt to all these real estate transactions and spiral us to a crash. Hey, that's my opinion. Thanks for watching. I'll see you next time.